Hey everyone, welcome back to Corporate Decoder. Today, SHAK just filed a current report on Form 8K, and I'm seeing updated guidance that investors need to know. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about SHAK lowering its financial expectations for the year. And that is a big deal for shareholders. Alright, so what exactly happened here? SHAK Incorporated is putting out an update, essentially saying they are not going to hit their previous financial targets for this year. They sent out a press release on the 2nd of June with this information. This filing is a bit different from the regular deep dives into a company's financials like a 10Q or 10K. Instead, this is a current report filed because something important has changed, and that something is their outlook. This is typically done to make sure investors get the most up-to-date information quickly. The company, SHAK Incorporated, is letting everyone know they are adjusting their financial predictions. This guidance was initially given out on May 7th, so it has been about a month since they last gave investors their numbers for the second quarter and the full year of 2026. The key takeaway here is that they are updating their guidance downwards. Think of guidance like a forecast. Companies issue it to give investors an idea of how they expect to perform financially. When a company revises its guidance, especially downwards, it means their actual performance is likely to be worse than they initially thought. So the press release itself, which is attached as an exhibit to this filing, contains the actual details of the revised guidance. However, the filing itself doesn't go into those numbers. It is more of a notification that this update has happened. The important thing for investors is that this news is public and can affect the stock price. Looking at the external news that came out around this filing, it seems this guidance cut has already started to impact how Wall Street sees SHAK. Headlines are talking about stock prices slipping and price targets being cut. This is a common reaction when a company lowers its outlook, for instance. On the 2nd of June, there were reports that SHAK was lowering its revenue and profit outlook amid uncertainty. This suggests that the company is facing some headwinds that are impacting their sales and profitability. This kind of news often leads to a dip in the stock price. We have seen similar situations with other companies in the restaurant industry when they face unexpected challenges. For example, if a company like McDonald's or Starbucks suddenly announced they were cutting their earnings forecast, you would expect their stock to see a negative reaction. The fact that the stock is trading at a 2-year low after cutting guidance further emphasizes the market's negative reaction. This indicates that investors are concerned about the company's future performance. It is like when you are planning a road trip and you realize you might not have enough gas to reach your destination, so you have to adjust your plans. Companies do the same with their financial targets. The news also mentioned an investigation into the officers and directors of SHAK. While this filing is primarily about the guidance update, such investigations can add another layer of concern for investors, potentially pointing to issues beyond just the current economic environment. In situations like this, where a company revises its guidance downward, it is often useful to look at how similar companies have fared. For example, if we look back at other consumer discretionary companies that have had to significantly cut their earnings expectations, we sometimes see a prolonged period of underperformance as they work to regain investor confidence. A significant guidance cut can sometimes lead to a 10 to 20% drop in stock price in the short term, and if the underlying issues persist, the stock may continue to struggle. Now, it is important to remember that this filing is an event-driven disclosure. The core financial details of what has changed in their guidance would be in that press release. However, the fact that they felt the need to file this 8K and update their guidance so soon after the previous update on May 7th suggests that the situation may be more serious than a minor adjustment. It is also worth noting who the major institutional holders are. Companies like BlackRock and Vanguard are significant investors in SHAK. When these large institutions see a company revise its guidance downwards, they often reevaluate their holdings, which can further impact the stock price. Their large ownership stakes mean their actions can have a substantial effect on the stock's movement. Looking at these numbers, SHAK's market cap is around $2.4 billion, and the P/E ratio is about 58. Before this guidance cut, the stock was trading around $57. However, with the recent news, it has slipped significantly, even trading at a 2-year low. This highlights the sensitivity of the market to forward-looking financial information. The company has a substantial number of employees, over 13,000. Which means that any downturn in business could have a wide-ranging impact. So, what is the story here? SHAK. A company that investors have put a lot of money into is telling them that things are not looking as good as they anticipated just a few weeks ago. This is not ideal for shareholders, and it suggests that there may be underlying issues impacting their business. The SEC requires companies to disclose material information to the public, and a change in financial guidance is definitely considered material. This filing ensures that all investors have access to the same information at roughly the same time. Ultimately, this filing tells us that SHAK is facing some challenges that are forcing them to lower their expectations for the rest of the year. What those specific challenges are would be detailed in the press release they issued. The market's reaction, as seen in the news headlines, clearly indicates that this is a significant development for the company. Now, looking at this more broadly, SHAK operates in the restaurant industry, which can be very susceptible to economic slowdowns and changing consumer spending habits. When people have less disposable income, they tend to cut back on dining out. This guidance revision could be a signal that they are seeing that trend. The risk I am watching is how long these headwinds will last. If this is a temporary blip, SHAK might be able to recover quickly, but if it indicates a more fundamental shift in consumer behavior or the competitive landscape, it could mean a tougher road ahead. What I am actually looking for next is the detailed breakdown of the guidance in the press release to understand the exact reasons behind this revision. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.